Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And with me today I have Victor, who is also a senior consultant. And today we are handling lesson 21 of the fixed assets module. And Victor, please walk us through.
Thank you, Bob, for the introduction. Welcome, everybody, to this lesson in our Financials Functional Training series. In this lesson, we are going to talk about retiring assets. Okay, this is a concept we have mentioned plenty of times before, and we know what it means. When we retire an asset, we are taking it off our books. It's no longer in our books. This could be because of various reasons. So we retire assets for various reasons. One of them is that we could have sold them, they could have been stolen, they could have been damaged, they could have reached their end of useful life, okay? Which perhaps should have been their first reason there. But we can be forced to take our assets off the books for any of these reasons. So the navigation is that we go to the asset workbench if we want to retire an asset, okay? Now, I just want us to remind ourselves a bit about the accounting for asset retirement. We are going to look at let's start with this, whereby we are selling an asset, and this involves AR module because of the sale of the asset. We don't have AR module set up yet, so we're not going to implement this part practically. But we are just going to remind ourselves of this accounting, okay? So in the receivables part, of course, you will have this part with the transaction whereby you send the customer whatever it is that will be an invoice in their system, okay? And then when they pay you, they'll give you cash. So your cash will increase, your receivables will go down, your proceeds of sale will remain, okay? This is the FA part of the transaction when you retire the asset, okay? So retirement, of course, it means that you are debiting accumulated depreciation and you are taking off the whole asset cost. Then there's going to be this proceeds of sale clearing, okay, which will cancel with what we had here. So this proceeds of sale cancels with this, okay? Why do we have this gain from the proceeds of sale, okay? So the net is going to be this. Accumulated depreciation will be debited, asset cost will be credited. You will get an increase in cash, which was the proceeds of sale, and the gain and loss, you will get a 20 gain, okay, because of this proceeds from selling. Now you can have a retirement with cost of removal, and we know about this also, but we are going to go through it, okay? So when you have your cost of removal for the invoice, instead of entering a normal expense account that we do when you're entering an invoice, the account you enter in the distribution is going to be the cost of removal clearing. The liability account, of course, defaults down from the supplier side. when you make the payment, you reduce your liabilities and you reduce your cash also, because you're making a payment. So you're taking out cash and giving it to the person who you paid to remove the asset. You're still left with this cost of removal clearing though. When we go to FA for the retirement part, retirement, of course, it involves debiting accumulated depreciation and crediting the asset cost. You have cost of removal clearing will be credited on this part of the transaction, which will cancel out with this. Okay. We have a loss in this case because we are paying to have our asset removed. So our gain loss account will be hit with a loss. And this is the accounting that will be created by assets for this retirement. The net of all of those two parts, the FA part and the AP part, is this, whereby you have the retirement and the gain, the loss, and the cash, which you pay out to have that particular asset removed. So now we can implement this part or this instance, this scenario, whereby we are removing an asset with the cost of removal because we have AP, right? So what would we need to do? We need to have an invoice showing this, where the debit is going, the distribution account is the cost of removal clearing account. When we go to FA and retire the asset and create accounting, this is what we will get. Okay. How will FA know the cost of removal clearing account? Remember, we entered this for our natural accounts under the book controls. Okay, so we had a cost of removal clearing account that we specified there. Of course, we specified just the natural account segment. Okay. But we have also the generator defaults. Okay. And if we do this using payables, of course, we can link it to the invoice and that distribution account, which will be the cost of removal clearing. So we are going to go to Oracle and we are going to do a retirement with cost of removal. We don't have to enter the payables account immediately. Okay. We can do that after, and the reason why we would do that is so that we can cancel out this cost of removal clearing account. So in order to do a retirement, I will go to, okay. Let me log in. So I am at the asset workbench. we can pick an asset to retire. Okay. There's one which we changed the date placed in service. I want us to retire that one. So that's February. Would have been the tractor. 10th February. Okay. Cabinet for conference room. Okay. So we can retire this one with a date placed in service of January. It's the one that was placed in service the earliest among our assets. That's why I want us to use it. Okay. So this asset accumulated depreciation is $25. Some is an adjustment from when we change the date placed in service. So the adjustment is depreciation from the previous period, which we chose to expense in the current period instead of amortizing. Okay. So when we retire this asset, what do we expect? We're going to bring down the cost to 0. We're also going to bring down the accumulated depreciation to 0. Now, book value is equals to cost minus accumulated depreciation, which is 425. So this 425 is value that we're not going to be able to expense. We paid for this, but we are not going to be able to expense it because we are retiring it before we can, before the useful life is over. So what do we expect? We expect some book value loss. If we go ahead and retire it with costs of removal, we also expect some loss from the cost of removal. All right. We are not going to do a retirement which we have proceeds of sale. So in order to do the retirement, we have this. This is the one that we are going to retire. So we can keep that as our retire date, and based on the convention, a retirement date will be obtained by the system. Now, for retirement, you can have a partial or a full retirement. So that is why we need to tell Oracle the cost that has been retired. So we want to do a full retirement. If you have multiple units for your asset, and which you had entered when you're adding the asset, then you can tell Oracle how many units have been required, and it can calculate the cost that has been retired based on proportions. okay? Or you can enter the cost, and Oracle will divide the retired cost among the units that you have, if you have multiple units. So let's say for this we had a cost of removal of $30. So remember the cost of removal clearing account we entered for our natural accounts in our book controls, okay? There's other information that you can enter here, such as the invoice number, or if it was a trade-in, you can enter the asset that was traded in. You can enter the person who you sold this asset to if it was sold. Of course, for us, it was not sold because of no proceeds of sale. We just had somebody come and remove it for us. So with that, you can click on done. So which one did you retire? We retired the cabinet for storage for conference room. And now you can see here that the cost has gone down to 0. Okay. I want to query Maskani here. You can see here that the status says pending. The information there under financial inquiry shows that the cost has been zeroed down, okay? Cost has been credited to 0, and however, this status here says pending. Why? This will not be complete until we run gains and losses program, calculate gains and losses program, okay? So that is when this will be complete, after we have submitted the gains and loss program. And the gains and loss program will calculate the gains and losses associated with retirement. Where do these gains and losses come from? Proceeds of sale, cost of removal, net book value loss, okay? So once that program has been run and the gains and losses have been calculated, then this will go to complete. All right. When do we run gains and losses? Actually, when you run depreciation, the gains and losses program is also launched. Okay. However, we can also run it on its own. And it will calculate the gains and losses associated with retirement for any assets that we have retired. So we have already done the retirement for this. Now when we run that program, this retirement will be complete. So that's what we're going to do. Other. Okay. And let me see, calculate. Calculate gains and losses. The book should be Mascani. So I will submit this. I do not want to submit another request. So we shall wait for this to complete, and then we shall create accounting, and we will see the accounting that is associated with retirement. So gains and losses has completed. Now we can go and create accounting. Okay. Remember, create accounting, we said it will create accounting entries for all the events that have taken place after the last create accounting run. So we can come here and create accounting. We can call this Mascani. What is this? Retirement batch. And I'll submit that. We can switch responsibility and go to GL. And now we can wait for create accounting to finish so that we can go and look at the journals that are created for retirement, and hope we don't know whether there are any other journals for any other events we had done after the previous create accounting run. So just remember what I said also, that this calculate gains and losses program is launched when you run depreciation. Okay. So if it's the end of the period and you're running depreciation also to close the period, gains and losses will also be calculated if for any retirements that may have taken place during the period. So when you create accounting, you will see the entries for that. So accounting created with a warning, journal import is complete. Let's go and see the journals first. So this is our retirement batch. Oh, I didn't remember it being this huge amount. Okay, we don't have any this look like transfers. For the transfers, I think we did in our previous session, and no accounting for retirement. So maybe that's the for gains and losses and retirement. So maybe that's the warning. Let me view the output. Okay, so transfers are okay. Retirement. It has errors. So here is the cost of removal. Error. The subledger journal entry does not balance in the entered currency. Please verify the entered amount. So it says there's something that's not balancing. Subledger journal entry. Okay, so let me take a look at it and we will resume. So we have identified the issue, but I haven't been able to figure out what the solution is. It is affecting the entries in our subledger level reporting currency ledger. If you check here, you can see this amount here, 437 and 50 cents. Is supposed to be converted to Kenya shillings, but it's still the amount in US dollars. So these two sides are not balancing. Okay, because you have this 43,650, and then here you have 437. So that's why we didn't have accounting entries sent to GL because of this error. On the primary ledger, though, the entries were created. Okay, so we're going to try and work with what we see here for the retirement. Okay, so the first line is a credit of 450, which we remember was the cost of the asset. So we are crediting the asset cost. Okay, so we are taking out the asset. That asset had some accumulated depreciation. Okay, and here it is 1250. Okay, we had cost of removal. Cost of removal clearing is this 5200 account here, which you see as being credited. And then we have a gain and loss account here, 4300, being debited to cancel out this cost of removal clearing. Remember, we entered $30, so these two cancel. We also have another entry that goes to our gain and loss account, this 4300 for 437.50. And if you add 437.50 to 1250, you'll realize it gets to 450. And this is the book value loss. This is the amount that we won't depreciate because we have retired. We won't expense this amount because we have retired the asset before time. Okay, and that is where that comes from. And this sides balance out as 480 on both sides. Okay, so this journal contains the entries for that particular retirement, including the gains and losses. So we might have, if we leave this entries like this, we will leave this clearing account with a balance. Okay. And why would it have a balance? Is because we don't have the invoice for the cost of removal. So these amounts have balanced out, but these are two different accounts. Remember, this is the gain-loss account, and this is the clearing account. It's just the amounts that are balancing out. And the loss here of 30 is actually because of this cost that we are paying for removal. And that's hitting this cost of clearing account. Remember, this accounting comes from assets. The other place where we should enter the cost of removal clearing account is in payables when we're entering the invoice. But we haven't done that, and we haven't created accounting from payables. So that's why we are not seeing that side of the transaction, because we're only looking at the accounting created by assets. But as you can see, that is the accounting created as we expected. In this part, balanced okay. This reporting currency ledger part had a few problems, and apologies for that inconvenience. But we were able to look at these entries, and this should serve our purpose. Anyway, that's what we had planned for this lesson, and we can end there unless you have something to add, Bob.
Right. Thank you so much, Victor.
Thank you.